Well, I think the thing is that the nature of markets has changed in my view. There's an awful lot more passive or indexed investment, which means there's a lot more correlation of asset classes going on. A lot of this is driven by liquidity, which is a common denominator. So if liquidity goes down, everything goes down. And so I think there is a case for saying that if you get, what follows the everything boom is the everything bust. I think there's a lot in that. And if you sort of drill down into the equity markets, I mean, this cycle is the first one that I've seen in decades, whereby the US market, for many advisors, is being treated explicitly as the world market. So I think that, that makes a difference. So it means that if US liquidity goes down and US liquidity is a major driver of the global picture, then everything kind of goes down together.
Michael Howell is the managing director of CrossBorder Capital, an independent research and investment company based in London, which he founded in 1996. A veteran in financial markets since 1981, Howell is a widely recognized figure in global finance, known for his insightful commentary and expertise. He is best known for developing a pioneering liquidity methodology that tracks cross-border financial flows and central bank activity across 80 countries. This innovative approach provides a comprehensive view of global liquidity, making it a critical tool for understanding financial markets and economic trends. In recent years, Howell has discussed the Federal Reserve's approach to quantitative easing and tightening in several publications. In a December 2022 article for the Financial Times, he observed that despite the Fed's ongoing QT policy, net liquidity provision had increased in 6 out of 9 weeks, with the Fed adding $157 billion to U.S. money markets. He suggested that while the Fed was reducing its holdings of U.S. Treasuries, it was simultaneously injecting liquidity, effectively engaging in stealth QE. In a recent interview with WT Finance, Howell exposes how this became an even bigger practice for the Janet Yellen-led Treasury Department in 2024 in a bid to secure Joe Biden's re-election bid. According to Howell, this not QE saw the Treasury Department injecting up to $1 trillion into the U.S. economy when it should have been doing the opposite to help combat rising prices. Howell fears this stealth QE might have worsened the everything bubble and doomed the entire global economy and financial markets. While Yellen's and Jerome Powell's stealth activities were limited to the United States, Howell warns they will have far-reaching consequences across the globe, as advisors have, in recent years, been treating the U.S. market as the global market. With the incoming Donald Trump administration coming in to put a permanent end to these treacherous activities, Howell says the global economy is in for some difficult months, if not years ahead. We will present clips from Howell's interview. But before we do, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
Well, I think the outlook is sort of fair to middling, but it's certainly not as bullish as it was, this time last year. I think unambiguously, in January 2024, the outlook looked to be pretty good at a time when there was actually quite widespread pessimism among many advisors. And so it was a relatively straightforward call. It obviously never is a straightforward call, but it was a relatively straightforward call to say that markets were likely underpriced and they'd go up. And that was true generally across risk assets, including the sort of celebrated crypto and Bitcoin. So a lot of those assets did look, undervalued against liquidity a year ago. That's not really true today. And what they're really dependent on is greater momentum from liquidity. And that momentum doesn't really seem to be coming through, and it's not coming through from the US, partly because you've got uncertainty over the funding program when the new administration comes in, and a lot of the juice, if you like, in liquidity in the US last year was really because of the funding change, where Janet Yellen managed to skew US Treasury funding very much towards the short end. Now, I know that's a sort of fairly wonkish idea, but it did actually add significant liquidity in the US markets. And allied to that, the Federal Reserve was doing what we sort of somewhat flippantly call not QE, which was adding liquidity despite the fact its headline policy was actually a QT policy, quantitative tightening, but they were actually adding liquidity. And they managed to add substantially last year, maybe as much as about $1 trillion US. basically, secretively or in a hidden easing. So those factors are really beginning to wane. Now, if you want to illustrate that process, which I think is an important thing to kick off with, if you take a look at a slide that I've got, which is actually well into the presentation, about slide 17, it shows the chart there, which is looking at our calibration or our measure of what we call not QE. So in other words, the hidden quantitative easing, and also the not yield curve control, which is the hidden easing coming from the Treasury when they're doing a yield curve control, not really fessing up to it. And basically what that illustrates is that there's an impetus in US markets last year of upwards of about $6 trillion, or very close to that, of actually additional, or let's say hidden stimulus. And that was one of the main reasons that the S&P went up 25% last year, and why crypto was good, etc., why gold went up. All these features are really phenomena of more monetary liquidity. What you're seeing lately is a fairly sharp decline in that stimulus. That impetus has come right down to under $1 trillion, and it looks like it's fading very fast as we head into deeper into 2025. So that's one thing I think one's got to be pretty cognizant of. I mean, the other thing that you've got in the background is basically what's going on in China, and the situation in China just isn't good, and that comes back to debt. It comes back to debt, and I suppose as well the US dollar, and that combination is really proving a poisonous cocktail for the Chinese economy. And just to sort of refresh kind of what's happening there, we know that China's got a huge debt burden, and the economy is really struggling under the weight of that debt. The only way you get out of debt, and particularly debt deflation, which is what China is suffering right now, is to create an offsetting monetary inflation. Now, if you create a monetary inflation, by definition, you're going to destroy the value of your paper money. In other words, you're thinking about currency devaluation. And China is really insistent on maintaining as close a parity to the US dollar as it can. So it's trying to hold the yuan cross against the US dollar as near as damn it on about 7.3 yuan to the US dollar. And that's proving extremely difficult exercise. Now, in order to do that, what they're doing is they're tightening monetary conditions. And that tightening of monetary conditions is basically causing both the Chinese economy to slow down, and we would suspect as well, in looking at sort of upcoming data, it will be showing a decline in the world economy. And if you want to look at that, there's a slide, again, a little bit deeper in the presentation, around slide 11, which is showing that correspondence between PBOC, People's Bank of China, liquidity injections, or actually, as we speak, liquidity withdrawals, and the tempo of the world economy as gauged by a nowcast, a daily nowcast that we put together. And the correlation between those two series is pretty decent, with the Chinese liquidity leading by about 3 months. So if you look at that chart, the omens are clearly not very good for what's going on. So basically, the strong dollar against the background of debt in China is causing China to withdraw liquidity. And then that comes on top of this declining impetus that we're seeing in the US. So generally, the outlook is, as I say, not great. If you take a look at a slide early on in slide 3, we actually track our estimates of global liquidity growth in dollar terms against the performance of all world asset markets. The black line on that chart is all world asset markets, and the orange line is looking at our estimates of global liquidity. And we push that forward to the end of 2025. And you can see at best there's a flatlining going on. And, at worst, that probably could trigger some market correction, given the fact the markets, often price off the margin. And if they see a loss of momentum coming through, that's clearly a dangerous feature. And then if you want to, maybe just before I stop, the other thing to think about is everyone's favorite risk asset now, which is Bitcoin. We show on the following chart, slide 4, the very close correlation between movements in Bitcoin and movements in global liquidity, where we pushed global liquidity here forwards by 3 months to show that it's a predictor. And again, if you look closely at that chart, The black line here is looking at liquidity growth. And what that's showing is a fairly noticeable decline after what had been a decent third quarter. But because liquidity leads, that obviously explains why Bitcoin has been strong in the period up to end December, and maybe why it's coming under some pressure now.
Howell emphasizes that central bank liquidity plays a pivotal role in shaping global markets. He defines liquidity as a measure of the flows of credit and savings that pass through world financial markets, highlighting its influence on asset prices and market dynamics. Howell notes that central bank policies, such as those implemented by the Federal Reserve and the People's Bank of China, significantly impact global liquidity. He points out that these institutions' liquidity injections into markets can affect the availability of credit and the movement of capital across borders. In his analysis, Howell suggests that an increase in global liquidity, driven by central bank actions, can create a favorable environment for liquidity-sensitive assets, including stocks, gold, and cryptocurrencies. He observes that when central banks expand their balance sheets, it often leads to higher asset prices as investors seek returns in a more liquid market. This is what he says happened last year, with several assets achieving new all-time highs. Bitcoin surged to an unprecedented $108,135 on December 17, 2024. Gold reached a record price of $2,757.40 per troy ounce on October 23, 2024, marking its best performance in 14 years. Various U.S. stock market indexes, including the S&P 500 and the Dow Jones Industrial Average, also achieved new all-time highs, as did assets under management in global ETFs, which hit a record $13.8 trillion by the end of 2024. Howell warns that 2025 will be marked by a significant reduction in liquidity, which will have adverse effects on markets. He explains that decreased liquidity may lead to higher volatility and lower asset prices, as the reduced flow of credit and savings constrains investment and spending. This sharp reduction in liquidity is all thanks to Yellen and Powell's not QE, which Howell discusses at length in his interview. Let's get back to the video.
If you look at that chart, and bearing in mind that liquidity leads markets, the peak in that chart occurred early in 2024. So it was really having its effect both on markets and more particularly on the economy, around the time of the election. And, it's true that, incoming Treasury Secretary Scott Bessent has already, labeled Jay Powell and Janet Yellen at Fed and Treasury respectively kind of cheats in trying to, bolster the markets to get Biden reelected. And, that's a pretty, cute spot by him. But it's evident in the data. And the way that we look at it is to say that if you look at the Fed and what the Fed is doing, or what the Fed is doing sort of sous la table in terms of hidden policy, this not QE, as we sort of flippantly call it, is basically saying that what they're doing is they're purportedly doing QT, quantitative tightening, but actually they're injecting liquidity. Now, how can they do that? How can we square that circle? And that is because they define their QT in terms of the overall balance sheet size. So the overall balance sheet of the Federal Reserve is definitely shrinking. That's not a question. But not all items on the balance sheet actually create liquidity. So even though the overall balance sheet is shrinking, the non-liquidity creating parts are falling much faster, and the liquidity creating parts are actually expanding. And specifically, things like the reverse repo facilities being wound down quite dramatically. You've got fluctuations which are occurring in the Treasury General Account, which is an account that the Treasury holds at the Fed. It's like a cash deposit account. They can run that down or build that up. And that's been a source of liquidity at different times. You've got the Bank Term Funding Program, which was a support program put in place during the Silicon Valley Bank turmoil. That's now run off, but it was adding liquidity through the year. And you've also got the operating losses that the Federal Reserve is suffering because it's paying out more interest, to coupon holders than it is taking in, or it's paying out more on the, I shouldn't say the coupon holders. It's basically paying out more on the reverse repo facility than it's taking in, and that basically is a source of loss. but it's actually an injection of liquidity for markets. So all these factors add up. And you can see on slide 15, we calibrate that in what we call not QE. Now, that's one source of impetus that people haven't really figured with. And that's a way of directly injecting liquidity into money markets. But there's another way of actually assessing liquidity, which is really looking at the duration impact of Treasury issuance. Now, if you're issuing a long-dated coupon bond, let's say a 10-year bond, or there or thereabouts, a longer-dated tenor, in other words, that will absorb balance sheet capacity among financial institutions and will basically take liquidity out of the system. And that is clearly a negative. And the more funding at the long end there is, the more that you get that liquidity being, if you like, soaked up by this issuance sponge, this coupon issuance sponge. Now, what Janet Yellen very cleverly did is change the parameters of how the US Treasury issues debt. She skewed a lot of issuance into Treasury bills, which are non-coupon paying securities with up to 1 year of maturity. And the reason they're very attractive is that the banks tend to hoover those up because with a very active fiscal spending program going on, banks are getting a lot of bank deposits built up, and they need an asset on the other side of their balance sheet that duration matches those deposits. And what better than a short-dated Treasury bill? So the banks are very keen buyers of that stuff. And the other thing that Janet did was she also skewed the calendar of coupon issuance very much towards very short-dated coupons, 2, 3, 5-year coupons, away from longer end coupons like 10 or 20 or even 30-year. So she took about 1.25 years at least out of the average maturity of the calendar of issuance by the Treasury since the end of 22. So these things are really important. And the slide 16 basically calibrates that effect. And if you look at it, you'll see that actually that sort of liquidity impulse measured in terms of dollar duration was equivalent to what we saw during the COVID time. So, this is additionally, one should say, on top of the fiscal spending stimulus you're seeing. This is purely by changing the dial or whatever on the maturity of Treasury funding. So it's very important. Now, you can also see, while I'm on this subject, the impact of that on yields. And if you take a look at slide 18, what that's showing is the difference between the stated or headline or actual, I suppose it's fairer to say, Treasury yield of the 10-year tenor. So what US government bonds are actually yielding in the market, which is shown as the orange line, and a bootstrapped version of that data, which has come from the agency mortgage market. Now, the agency mortgage market is a risk-free securities, very much like treasuries. They're held by central banks, even by the Federal Reserve. They're taken as risk-free instruments, and they should align exactly with the treasury market once you made a little bit of an adjustment mathematically for duration differences and convexity differences, but that's getting into the weeds of bond speak. But generally, they should line up. And if you look at that graph, what you can see is that they haven't lined up during this period of so-called cheating by the Treasury, or this big skew towards the short end of the issuance curve. And what that shows is it's basically about 100 basis points of difference in spread. So the Treasury market, the actual bond yield in the US, has been artificially suppressed by about 100 basis points. Now, what does that really mean to market participants? What it means is that, number one, obviously yields are lower than they should be, but it means that the yield curve is artificially depressed and was actually forced or was magically inverted when it shouldn't really have been. So had you used the agency mortgage market to cue as a cue for your yield curve calculation, you'd have seen that actually the curve was more likely upward sloping, indicating a strong economy, rather than negatively sloped, indicating potential recession. And that clearly, upset calculations of a lot of economists who didn't quite see that point. The other thing which is important, and is particularly important in the light of recent data, is that it also means that the TIPS market, the Treasury Inflation Securities market, is biased by about 100 basis points. So in other words, break-even inflation rates in America, stated break-even, the long-term or underlying inflation that the Treasury market is discounting, is again distorted by 100 basis points. So it looks as if underlying inflation in America is about 2 percentage points over the next 10 years, 2% per annum. Actually, in reality, it's over 3%. So the Fed is already sort of distorting people's perceptions here. There's more inflation and there's a more robust economy than we've been led to believe. And that clearly is going to be an issue that Scott Bessent has to tackle when he gets in to Treasury on 20th of January.
The incoming Donald Trump administration is expected to differ significantly from the Joe Biden administration, particularly in the area of policy implementation. While the Biden administration focused on tax increases, increased regulation, and strengthening alliances with other countries, the Trump administration plans to focus on tax cuts, deregulation, particularly in industries like energy, manufacturing, and finance, and America First trade policies, such as renegotiating trade deals and reimposing tariffs on imports. The Joe Biden administration also made a big deal about investing in green energy, while the Trump administration will encourage U.S. energy independence through fossil fuel expansion. There is also the issue of the United States' $36.3 trillion nation debt, which President-elect Donald Trump has promised to tackle head-on, with the support of people like Treasury Secretary nominee Scott Bessent, who has emphasized the necessity of cutting federal expenditures to address the fiscal imbalance, and Elon Musk, who has been tasked with identifying potential spending cuts, aiming for reductions between $1 to $2 trillion annually. This is certainly a new dawn for America and the American people. If these policies are properly and swiftly implemented, the first months of transition will go by quickly without any lasting damage. Please share your thoughts on Michael Howell's outlook for global liquidity and markets in 2025. If you liked this video and want more like this, also ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.